The global economy is at a crossroads. Inflation remains a concern, even as some key indicators show signs of cooling. Central banks are walking a tightrope, balancing the need to control prices with the risk of stifling economic growth. Meanwhile, financial markets seem to be betting on a soft landing, with inflation easing and interest rates falling. But is this optimism premature? Could markets be headed for a rude awakening? The latest inflation data from major economies paints a mixed picture, leaving investors and policymakers alike grappling with uncertainty. The coming months will be crucial in determining the trajectory of the global economy. Will inflation continue to moderate, allowing central banks to ease off the brakes? Or will persistent price pressures force them to keep interest rates higher for longer, potentially triggering a recession? Understanding the forces at play is essential for investors seeking to navigate these turbulent times. Let's examine the recent inflation reports from three major economies: the United States, the Eurozone, and the United Kingdom. Each region presents a unique set of challenges and opportunities. In the US, March 2025 saw inflation ease to 2.4%, offering a glimmer of hope that the Federal Reserve's aggressive rate hikes might be having the desired effect. However, April's data, expected soon, will be crucial in confirming this trend. The Fed remains cautious, holding rates steady at its last meeting. The uncertainty surrounding new trade tariffs adds another layer of complexity. Across the Atlantic, the Eurozone's flash estimate for April 2025 inflation came in at 2.2%. While this figure remains above the European Central Bank's 2% target, it does represent a slight easing from previous months. Energy prices, a major driver of inflation in the past year, continued to fall. However, rising services inflation is a cause for concern. The UK presents a different picture. Despite cutting interest rates to 4.25% in early May, the Bank of England projects inflation to rise to 3.5 to 3.7% in the third quarter. This temporary spike is attributed to energy prices and regulated costs. The bank expects inflation to fall back to the 2% target in the coming months. However, global trade policy uncertainty and the ongoing impact of Brexit add considerable uncertainty to the outlook. The fight against inflation comes at a cost. Central banks around the world have been raising interest rates aggressively, aiming to cool down their economies and bring price pressures under control. While necessary, these higher borrowing costs are having a ripple effect across the globe, impacting consumers, businesses, and investors alike. For individuals, higher interest rates translate into increased costs for mortgages, car loans, and credit card debt. This reduces disposable income, potentially dampening consumer spending, a key driver of economic growth. The housing market in particular is feeling the pinch, with rising mortgage rates cooling demand and slowing price growth. Emerging markets, often reliant on foreign capital, are facing headwinds as well. A stronger US dollar, a consequence of higher interest rates in the US, makes it more expensive for these countries to service their dollar-denominated debt. This can trigger capital flight, putting downward pressure on their currencies and increasing the risk of debt crises. Different sectors of the economy are also experiencing the impact of higher rates in varying ways. Technology and growth stocks, which often rely on borrowed money for expansion, are particularly sensitive to rate changes. Real estate, as mentioned earlier, is also feeling the heat. Consumer discretionary spending is likely to decrease as households tighten their belts. On the other hand, value stocks and defensive sectors such as utilities and healthcare may fare better in this environment. Despite the challenges posed by high inflation and rising interest rates, financial markets have shown remarkable resilience in recent months. Stock markets have rallied, and investor sentiment seems to be cautiously optimistic. However, this bullishness raises a crucial question. Are markets ignoring the risks of an inflation trap? The inflation trap theory suggests that markets are currently caught in a dangerous cycle of hope and hype. Investors are betting on central banks cutting interest rates sooner rather than later, fueling the market rally. However, if inflation proves more persistent than anticipated, central banks may be forced to keep rates higher for longer or even raise them further. This could trigger a sharp market correction, catching many investors off guard. Several factors could contribute to an inflation trap. Supply chain disruptions, geopolitical tensions, and the ongoing war in Ukraine continue to pose risks to global price stability. Strong consumer demand, fueled by pent-up savings and a tight labor market, could also keep upward pressure on prices. The Federal Reserve's preferred measure of inflation, the Personal Consumption Expenditures (PCE) price index, remains well above the central bank's 2% target. While the Fed has indicated a willingness to pause its rate hiking cycle, it has also stressed that it will remain data-dependent. In other words, any signs of resurgent inflation could prompt the Fed to resume its tightening policy, potentially surprising markets and leading to a sell-off. As we move through 2025, the global economy faces a range of potential outcomes. Understanding these different scenarios is crucial for investors seeking to position their portfolios for both opportunities and risks. Scenario 1. The soft landing. This is the most optimistic scenario. Inflation gradually cools, allowing central banks to start cutting interest rates later this year or early next year. Economic growth slows but avoids a recession. This Goldilocks environment would be ideal for markets, supporting continued gains in equities and other risk assets. Scenario 2. Sticky inflation and stagnation. In this scenario, inflation proves more persistent than expected, forcing central banks to keep interest rates higher for longer. Economic growth stagnates, potentially leading to a period of stagflation, where high inflation coexists with low growth. This environment would be challenging for markets, marked by volatility and uncertainty. Scenario 3. Resurgent inflation. This is the most negative scenario. Geopolitical events, supply chain disruptions, or a resurgence in consumer demand lead to a fresh wave of inflation. Central banks are forced to abandon plans for rate cuts and may even consider further hikes. This would likely trigger a recession and a sharp market correction. Predicting which scenario will play out is impossible with certainty. However, by understanding the key factors at play and their potential implications, investors can make more informed decisions and position their portfolios accordingly. Given the uncertain economic outlook, it's more important than ever for investors to have a well-diversified portfolio and a sound investment strategy. Diversification. Don't put all your eggs in one basket. Diversify your portfolio across different asset classes, including stocks, bonds, real estate, and commodities. This helps mitigate risk and protect your capital in volatile markets. Focus on quality. In uncertain times, it's essential to focus on quality companies with strong balance sheets, solid earnings growth, and a history of navigating economic downturns. These companies are better positioned to weather the storm and emerge stronger. Consider value stocks. Value stocks, often overlooked during periods of high growth, may offer attractive opportunities in the current environment. These companies are typically more mature, with established businesses and a track record of paying dividends. Don't try to time the market. Trying to predict short-term market movements is a fool's errand. Instead, focus on a long-term investment horizon and stick to your plan. Remember, time in the market is often more important than timing the market. Stay informed. Stay up to date on the latest economic data, market trends, and geopolitical developments. This will help you make informed decisions and adjust your investment strategy as needed. The global economy is at a critical juncture. Inflation remains a threat, even as some indicators show signs of easing. Central banks are walking a tightrope, balancing the need to control prices with the risk of stifling growth. Markets are caught between hope and hype, potentially setting themselves up for an inflation trap. Navigating these turbulent times requires vigilance, prudence, and a long-term perspective. By staying informed, diversifying your portfolio, and focusing on quality investments, you can weather the storm and emerge stronger. Remember, the key to successful investing is not to avoid risk altogether, but to manage it wisely.